Welcome back to the deep dive. Today we are digging into Cintas Corporation, that's ticker CTAS on the NASDAQ.
Hmm.
And if you follow them, you know they're sort of the quiet giant behind American business, a Fortune 500 company making sure over 1 million businesses are, as they say, ready for the workday.
That's a perfect way to put it. There's so much more than just the uniform trucks you see. I mean, they're into facility services, first aid, safety, fire protection,
All the essential stuff.
all the essentials. They're really, embedded into the basic health and safety of the economy.
Exactly. So our mission today is to get into their latest numbers. We're looking at the fiscal 2026 second quarter results, which just dropped on December 18th.
Right.
We want to unpack the key metrics, figure out what's really driving their growth, and talk about the big news they've raised their guidance for the full year.
And the headline from the CEO, Todd Schneider, really sets the tone. He called it another strong quarter with record revenue and an all-time high operating margin. So we need to see if the numbers really back that up.
Let's do it. Let's start right at the top with revenue. For Q2, which ended November 30th, they posted $2.8 billion in total revenue.
Yep. And that's up 9.3% from the $2.56 billion they did in the same quarter last year.
Which is solid growth. But, that headline number doesn't tell the whole story, does it?
Not at all. That 9.3% is just the starting point. The real insight, the aha moment, comes when you separate the reported growth from the organic growth.
Okay, so break that down for us. What's that distinction tell you about how healthy the business really is?
It tells you it's incredibly healthy. See, a small piece of that growth, 0.7% to be exact, came from acquisitions, stuff they bought.
Okay.
But if you strip that out and you adjust for a little bit of currency fluctuation, their true organic growth rate was 8.6%.
Wow. 8.6% on a base that large that's huge. That means their existing business, the current customers, they are just firing on all cylinders.
Firing on all cylinders is right. They aren't just buying growth. They're genuinely winning it day in and day out. In this kind of economy, that's a really powerful signal about their pricing power and just how deep they are with their clients.
So where is that 8.6% coming from? Let's get into the segments. The main one is still uniform rental and facility services.
That's right. That's the core. It brought in about $2.155 billion, and it saw a very strong, very steady 8.3% increase. That's the bedrock of the company.
The predictable part.
The predictable, recurring revenue investors love. But the really exciting part, the place you see the momentum shifting, is in their other category.
This is the first aid, safety, and fire services.
Exactly. And that segment grew by 12.8%.
12.8%. That's a huge difference. It's really outpacing the core business. Why is that? What's going on there?
Well, if you think about it, the regulatory environment for businesses is just getting more and more complex. All that pressure around safety, compliance, documentation, it's not optional anymore. Things like having the right first aid kits, certified fire suppression systems, proper safety training, that's a non-negotiable cost.
And Cintas is the easy button for that, the outsourced expert.
They're the easy button. And that revenue is often higher margin and, even stickier than just renting a uniform. It's a fantastic growth engine for them.
That makes a lot of sense. So we've got strong revenue growth, especially in these high-value areas. That leads us right to the next piece of the puzzle, the profit story. And this is where it gets really impressive.
It really is. The margin expansion this quarter is where Cintas proves its operational excellence. Let's start with gross margin. It was up 10.6% to $1.41 billion.
But the real number is the percentage, right? They crossed a big threshold.
They crossed a big one. Gross margin as a percentage of revenue hit 50.4%.
50.4%. That's up from 49.8% last year. So for anyone not living in spreadsheets, why is breaking that 50% barrier such a significant milestone for a company like this?
I mean, hitting 50% is it's a signal of incredible efficiency. It means for every single dollar of revenue they generate, 50 cents is left over to cover all their other costs and, of course, their profit.
For a business with so much physical logistics, trucks, laundries, deliveries, that's amazing.
It's astounding. It tells you they have just optimized everything. Their route density, their supply chain, their energy use. They are running an incredibly tight ship.
And you can see it in the core business too, right? Even in the massive uniform rental segment, the margin there ticked up.
It did. It went from 49.1% up to 49.8%. It's not a one-time fluke. It's deep embedded discipline across the whole operation.
And that efficiency, it just flows right down the income statement.
It does. Operating income was up 10.9% to almost $656 million. Their operating margin improved to 23.4%.
So they're holding the line on administrative costs even while they're growing fast.
beautifully. And all of that leads to net income of $495.3 million, a 10.4% increase. Which brings us to the number shareholders care most about.
Diluted earnings per share.
Diluted EPS came in at $1.21. That's an 11% jump from last year.
Just one quick technical note you pointed out. Their
Oh.
tax rate was a little higher this quarter.
Yeah, just a small thing. It was 21.2% versus 20.7% last year. It's mostly due to some discrete items around the accounting for stock-based compensation.
Yeah.
But the point is, even with that small headwind, the underlying business was so strong, it just powered right through.
Incredible. Okay, this is the perfect pivot to what I think is the most fascinating part of their story right now, capital allocation. How are they using all this cash they're generating?
And they are generating a ton of it. If we look at their free cash flow for the first 6 months, they pulled in $737.5 million. That's up from about $711 million last year.
And free cash flow is basically, it's the company's pure spending money, right? After all the bills are paid and all the investments are made to keep the business running.
That's it, exactly. It's the cash that is truly free for management to do what they want with. And Cintas made a very clear choice about what to do with it.
They chose to give it back to shareholders in a massive way.
The scale is just extraordinary. In the first 6 months of this fiscal year, Cintas returned $1.24 billion to its shareholders.
$1.24 billion. How did they do that?
It's a mix of share buybacks and dividends. In this quarter alone, they bought back $622.5 million of their own stock. And then they paid out another $180.7 million in dividends.
Okay, so this aggressive buyback plan, that's where their balance sheet strategy really comes into focus, because they're not just using cash on hand, are they?
No, and this is the key. To help fund this, they issued a net of about $551 million in commercial paper in the first 6 months.
Okay, let's stop there. For those of us not on a trading desk, what exactly is commercial paper and why are they using it for buybacks?
Think of it like a corporate IOU. It's short-term, unsecured debt, usually with a maturity of less than a year. Highly rated companies like Cintas can issue it at a very low interest rate.
So they're borrowing cheap, short-term money to buy their own stock.
Precisely. It's an explicit strategy to reduce the number of shares out there, which instantly juices their earnings per share. It's aggressive, but you could argue it's a calculated bet.
A bet that their stock's appreciation, or the EPS boost, will be worth more than the interest they're paying on the debt.
That's the bet. And given how predictable their business is, it's a bet they feel very comfortable making. But as we're about to see in the outlook, that debt isn't getting any cheaper.
Which brings us right to Section 4, the outlook and the raised guidance. So with all this momentum, the CEO felt confident enough to raise the forecast for the rest of the year.
Absolutely. They bumped up the whole forecast.
Yeah.
They now expect annual revenue to be between $11.15 billion and $11.22 billion.
And what about the bottom line?
They raised the diluted EPS guidance as well to a new range of $4.81 to $4.88.
That's a strong signal of confidence, but there's always fine print, right? What are the key assumptions baked into that guidance?
There are 3 main ones you have to know. First, it assumes the same number of workdays as last year. Second, and this is important, it does not assume any future acquisitions.
So any M&A would be on top of this.
It would be upside. And third, they're assuming foreign currency rates stay right where they are. So it's a pretty clean apples-to-apples forecast.
Got it. But even with that strong forecast, they were very direct about a couple of headwinds that are coming. Let's start with the one we just talked about, the cost of their debt.
Yes, this is where the rubber meets the road on their capital strategy. They're now projecting net interest expense for the full year to be about $104 million.
And that's up from, what, about $95.5 million last year?
Correct. So that's almost a $9 million increase in just their interest payments.
Why the jump?
It's 2 things. They did some refinancing of their long-term debt at higher rates, but the bigger variable factor is the rising interest rate they have to pay on all that short-term commercial paper they're using for the buybacks.
So the cost of that aggressive strategy is starting to show up directly on the income statement.
It is. A clear sign that even cheap debt isn't free, especially when rates are staying elevated.
Okay, what's the second headwind they called out? It's a tricky one for the upcoming Q3 comparison.
Yeah, this is a really important detail. In the third quarter of last year, Q3 of fiscal 25, Cintas had a one-time gain of $15 million from selling a piece of land.
A one-off event that won't happen again this year. So what does that mean for the Q3 numbers we're about to see?
It means there's a built-in $15 million headwind. When they report Q3 of this year, the numbers are going to be compared against a prior year that was artificially inflated by that sale.
So you have to mentally subtract that $15 million from last year's results to see the real underlying growth.
Exactly. It's the kind of detail that can trip people up if they're not paying close attention.
That's why we dig in. So let's tie this all together. What's the core message Cintas is sending with this report?
I think the message is one of just flawless execution. You've got powerful 8.6% organic growth. You have incredible efficiency pushing gross margins over that 50% line.
And a relentless focus on shareholder returns.
A relentless focus. They've deployed over $1.2 billion in just 6 months using debt as a tool to do it. And all that strength allows them to raise their forecast for the year, even while they're being totally upfront about rising interest costs and that tough Q3
A
comparison.
really phenomenal quarter. But that strategic choice to use debt so aggressively for buybacks, it does set up a fascinating tension for the future.
It absolutely does. And that leaves us with the final thought for you, the listener, to really consider. Cintas has shown they love using this cheap short-term commercial paper to fund buybacks and drive EPS.
Mm-hmm.
The question is this. If interest rates stay higher for longer, making that debt more and more expensive, at what point does that rising interest cost completely cancel out the benefit they get from buying back shares? And how would that change their commitment to returning that much capital to shareholders? That is the strategic tightrope they're going to be walking.